Hey guys, it's Mikkel here looking at one of the kind of investment grids and strategies you use to determine if a property is a good investment. Before I started doing residential real estate more heavily with buyers and sellers and investors, I actually did property management where I managed 15 to 20 properties with a partner of mine, and we actually worked with a lot of investors to help determine this strategy, as well as different cash-on-cash returns, internal rate of revenue, and other terms and phrases that a lot of investors use in order to determine what deal is a good deal. And two, most of these investors that we worked with, they solely dealt with townhomes, and we pushed them pretty heavily towards townhomes because we've experienced multiple times where investors think, oh, a single family home is going to attract more buyers, it's going to attract more families, but in the end, it's really a lot more work for the tenant and a lot more work for the landlord, because the tenant isn't going to want to upkeep your yard or care about exterior maintenance. They're not going to waste their time with that, right? So it's a lot easier when you have a townhome that doesn't have a yard and your HOA covers your exterior maintenance to actually keep your values high and keep the maintenance low for your tenant, low for yourself, and the stress low for yourself as well. So this is a real life example right now of a townhome in the Exchange in Lehigh, one of the most popular communities that Edge built a couple years ago and is continuing to build. This is a townhome, 3-bed, 2.5 bath that you can buy right now for $303,000. Right now, interest rates just dropped again, 3-year low. You can get locked into a non-owner occupied interest rate at 4%. And then the minimum to get into an investment property is 20% down. So at about $303,000, you're looking about $60,580 down that you're gonna need to come up with. Now this is broken down, so your monthly payment is gonna be $1,477, and this is all the breakdown of that. So you're gonna be paying quite a bit in interest, about $330 in principal, $121 for property taxes, $25 for condo or townhome insurance a month, and then $125 with your HOA and $50 for just regular upkeep and maintenance that we just want to allocate in there for your monthly payment. So total, that's going to be about $1,477 for your total expenses each month for the property. Now everybody thinks cash flow. What's my cash flow? Everybody, that's the trigger word for most people when it comes to investment properties. It's not the most important. I mean, it's definitely what people think and expect, but as we look through the rest of this year, it's not the most important. So with cash flow, right now you can actually lease a market value in the Exchange is about $1,750 a month. Expenses, we got this number here, is a $1,477. Total, you're gonna be cash flowing around $273 a month, which on average is actually pretty good because a lot of investors want a benchmark of at least $200. So you're already above that. Okay, so at $273 a month for the full year, you're about $3,300. Now, if we divide that by your initial cash your cash deposit, your down payment of $60,000, you're going to be looking at a return of 5.5%, 5.4% here. Okay, so that's one quadrant. That's one part of the of looking for an investment property. The next is appreciation. So right now, on average in Utah County, we're seeing about 5 to 10% appreciation rates. We want to be conservative, so we're going to go at 5%. Okay, so we're going to multiply 5% by the initial purchase price of around $303,000, and we're going to see $15,145. Now, we're going to divide $15,145 by your cash deposit of $60,580, and you're going to get a return of 25%. So that is your most profitable return, is through appreciation. Now this is extremely conservative, so if we were also to put 10 or what we're expecting for 2020, which is 10% appreciation in Lehigh, this is obviously going to be quite a bit higher. So this is on the conservative side. Now if we talk about tax benefits, a lot of people forget that there are a lot of tax benefits to buying real estate. I'm not a CPA. I suggest you all talk to your accountants and talk to somebody that's licensed in this field. But we did go over these numbers with our preferred accountant to make sure that this all makes sense. But once again, please be sure to talk to your own CPA about how this would work for you. But we wanted to take these numbers off a married couple that is filing jointly that's making around $100,000 a year. Now, when we do this, there's two sets of tax benefits. There's depreciation and mortgage interest. If you are able to depreciate any asset that you own real estate has a depreciation schedule of 30 years. So if we were to divide the purchase price of $302,900 by 30 years, divided by 30, you see $10,096. Now to figure out depreciation, then you multiply that amount by your tax rate. So at 22% for $10,096, you're looking at $2,200 roughly. Now, mortgage interest. Most of you know when you buy a home or you have an investment property, you're able to take that mortgage interest and actually write that off at the end of the year as well. So when we take that into account as well, right now with the first year of owning the home, you're gonna be paying most of your mortgage and interest. So at $831, multiply that by a year, so by 12, you're looking about $10,000. 10,000 divided by your tax rate of 22%, you're looking about $2,200 roughly. Okay, now you add these two together and you're gonna be around $4,400. Then once again, you divide that $4,400 by that initial cash deposit and you see a return of about 7.3% that you are gonna receive in tax savings. Now the last quadrant to kind of determine, how good this investment is looking is your debt pay down. So obviously when you have a renter in your home, you're not going to be paying for your principal payment. You're not going to be paying your interest or your principal. Your tenant is actually be paying that for you. So you're paying down your mortgage, not very quickly the first couple years, but as you continue leasing it out and the longer you go on with your loan, it'll obviously get higher and higher, the principal amount. But your first year, you're paying about $325 a month in principal. Multiply that by 12, that's $3,900. And then once again, you divide that $3,900 by your initial cash deposit of $60,580, and you receive a return of 6.4%. Okay, so putting all these quadrants together, cash flow appreciation, tax benefit, pay down, we're looking at a total return of 44.1%. Now, what do you know right now that's giving you that return in the stock market? Probably your real estate assets are actually giving you this kind of rate of return, and you might just be only focusing on cash flow. So it's good to take this, talk to us, and we can do this breakdown for any of your properties and for any future properties that you want. Now, a lot of people have this worry that the market's gonna crash or they're expecting it to fall any minute because everybody's so scared of what happened in 2008. One of my colleagues, he owned an investment property, a townhome, similar to this, just a couple blocks away. In 2006, he bought it for $179, and after the crash, it was worth actually only $138. So he took a really big loss on that, over $40,000 due to that fall in the market. However, he was leasing it out at $1,500 a month in 2006, and when the crash happened in 2008, 2009, he was still leasing it for $1,500. So lease rates stay the same. That's what we've learned over the time and time again when we've seen market corrections, market falls. Just think, well, my appreciation might waver, we might have some less profitable years than 5% return, but you're still gonna see cash flow, tax benefits, and pay down. Anyways, please feel free to give us a call with any questions. Text, call, email me. We'd love to run this on any of your properties currently or any properties you're looking to invest in. Thanks so much.